We build worlds with numbers, don't we? In the realm of finance, models are our architects, our cartographers, charting the course for our capital. From the quiet contemplation of an individual investor crafting a retirement plan to the grand strategies of institutions managing billions, these numerical frameworks are the bedrock of our decisions. We trust them implicitly, believing they offer a clear, objective lens through which to view the future. But what if these trusted architects are building on shaky ground? What if the maps they draw are based on assumptions we haven't even bothered to question? Benjamin Graham, the father of value investing, once observed that the essential difference between investment and speculation lies in the analysis and the soundness of the underlying values. He likened the speculator to a man who buys a horse being ridden by a stranger, trusting to luck for a safe return. In a way, our financial models can become those strangers. They are sophisticated constructs, yes, but they are not objective reality. They are representations built by human hands, guided by human minds, and therefore inherently infused with human assumptions. These assumptions, often buried deep within the intricate logic of a model, are the silent architects of both our potential successes and our most profound failures. They are the hidden currents beneath the surface, capable of steering us toward unforeseen shoals. In this exploration, we will begin to unmask these silent architects. We will dissect three fundamental, hidden assumptions that are pervasive in financial modeling, assumptions that, when left unexamined, have a relentless tendency to lead us into costly mistakes. Our aim is not to dismantle these tools, but to equip you with the critical vision to see beyond the numbers, to understand the why behind the what, and to build your wealth on a foundation of genuine, data-driven truth. Let us begin with the first hidden assumption that often undermines our financial models: the illusion of predictable stability. We have a deep-seated human tendency to project the past into the future, to assume that what has been will continue to be. Financial models, by their very nature, rely on historical data. They crunch numbers from yesterday to forecast tomorrow. But this reliance breeds a dangerous preconception that the future will behave much like the past. We often assume a kind of stationarity in financial markets, as if they operate within a predictable, unchanging rhythm. This is akin to a bridge engineer designing a structure based solely on the average wind speed recorded over the last 50 years, utterly neglecting the possibility of a Category 5 hurricane. Our models, too, can be built for normal conditions, blind to the disruptive power of what Nassim Nicholas Taleb calls Black Swan events, rare, unpredictable occurrences that have a massive impact. These events, by definition, lie outside the scope of historical averages, yet they can shatter models built on the assumption of continuity. This illusion of stability also infiltrates our understanding of diversification. We often believe that spreading our investments across different assets inherently protects us. However, during significant market crises, correlations between assets can break down, meaning many things fall together. Models that fail to account for this correlation breakdown during extreme stress will underestimate the true tail risk, the probability of severe losses. So, what do? We must move beyond simply looking at historical averages, implement scenario analysis and stress testing that actively incorporates extreme, yet plausible, events. Consider approaches that are not just resilient, but antifragile, strategies that can actually benefit from volatility and disruption, rather than merely enduring it. Our innate tendency to expect continuity, known as normalcy bias, can turn a model designed for safety into a silent trap, a beautiful edifice built on the shifting sands of assumption. Our second crucial assumption, the one that often causes our carefully constructed numerical worlds to crumble, is the myth of the rational actor. Many financial models are built on the premise that investors are logical, unemotional beings who process information with cold, calculated precision. They assume we are all perfectly rational agents, weighing probabilities and making decisions solely based on objective data. But this is where the idealized world of mathematics clashes with the messy reality of human psychology. Imagine a weather forecast that confidently predicts sunshine every single day in July, simply because it has rained only 20% of the time in past Julys. Such a forecast would be mathematically sound, based on historical averages, but it would completely ignore the psychological impact of a sudden, unpredicted thunderstorm. It fails to account for how people feel and react when faced with unexpected change. Behavioral finance has illuminated this hidden truth. Human emotions are not mere background noise. They are powerful drivers of market behavior. Biases like herd mentality, where we follow the crowd regardless of logic, loss aversion, our powerful fear of losing money, which often leads to irrational decisions, and anchoring, where we get stuck on initial pieces of information. These dramatically influence market prices. They often push prices far from where a purely rational model would predict them to be. This is the concept of reflexivity, where market participants' actions influence the very reality they are trying to model. Therefore, a truly robust investment framework cannot ignore this ghost in the machine. It must explicitly incorporate the insights of behavioral economics. This means understanding why markets deviate from rational predictions and, more importantly, how to potentially profit from these deviations or at least mitigate their impact on our own portfolios. The unquantifiable force of human emotion can render even the most sophisticated mathematical models dangerously inaccurate, turning our calculated predictions into mere wishful thinking. We arrive now at our third pervasive, yet often invisible, assumption: the mirage of perfect information. Financial models, particularly those used for valuation, often proceed as if they have access to complete, accurate, and entirely unbiased data. They assume that all relevant information about a company's future cash flows, its competitive landscape, and its internal workings is readily available and transparent. Consider a chef attempting to create a masterpiece, but using a recipe book where crucial ingredients are deliberately omitted or, worse, mislabeled. The resulting dish, no matter how meticulously prepared, will inevitably be flawed. Similarly, a valuation model that relies on incomplete or inaccurate inputs, especially when it comes to qualitative factors or hidden costs, is destined for error. The principle of garbage in, garbage out is never more relevant than here. The hidden truth is that corporate reporting, while regulated, is far from perfectly transparent. Management incentives can heavily influence forecasts, leading to overly optimistic projections. Accurately valuing intangible assets like brand reputation or intellectual property, or anticipating future disruptions from technological shifts or regulatory changes, remains incredibly challenging. These are not simple numbers to be plugged into a formula. Therefore, a critical strategy involves prioritizing qualitative analysis alongside quantitative modeling. Cultivate a forensic accounting mindset, one that relentlessly questions the inputs and seeks to understand the underlying reality. Recognize the inherent limitations of models like discounted cash flow (DCF) when future cash flows are highly uncertain or built upon the very assumptions we've been discussing. The siren song of precision in financial models can be alluring, creating a false sense of security that blinds us to the inherent ambiguities of forecasting and the profound impact of what we don't know. It's crucial to understand that these three assumptions, the illusion of predictable stability, the rational actor fallacy, and the perfect information mirage, are not isolated flaws. They are interconnected, weaving a narrative that can lead to a devastating cascade of errors. When one assumption is weak, it often weakens the others, and together they can amplify even minor inaccuracies into catastrophic outcomes. Consider an illustrative example. Imagine a financial model that assumes stable, predictable growth for a company, relying on historical averages. Assumption 1. This model might fail to account for the fact that the company's future performance is highly dependent on volatile consumer sentiment and unpredictable market trends. Assumption 2. Furthermore, the model might be fed misleading data from corporate reports, perhaps where R&D spending is presented in a way that obscures underlying inefficiencies or future challenges. Assumption 3. The compounding effect of these flawed inputs is profound. The initial assumption of stability is undermined by the irrationality of human behavior and the opacity of information. This interconnectedness reveals a deeper, systemic risk. When countless investors and institutions rely on similar, flawed models, these shared blind spots can amplify market downturns or inflate asset bubbles. The costly mistakes we often focus on at an individual level can, in aggregate, lead to widespread financial instability. We see the ripple effect, the interconnectedness of our financial ecosystem. Building a more resilient framework requires an iterative and deeply skeptical approach to modeling. It demands continuous validation of our assumptions, rigorous sensitivity analysis to understand how changes in inputs affect outputs, and an unwavering willingness to discard models that consistently fail reality checks. It's about treating models not as immutable truths, but as dynamic hypotheses to be constantly tested. The true cost of flawed financial models extends beyond lost capital. It encompasses the erosion of trust and the missed opportunities for genuine, sustainable wealth creation, the kind that is built on truth, not on the shifting sands of flawed assumptions. It's time to transition from dissecting the flaws to embracing a new way of engaging with financial projections and strategies. This means shifting from passive acceptance to active, critical engagement. We must move beyond treating financial models as infallible oracles. They are, at best, tools, and like any tool, their effectiveness hinges on our understanding of their limitations and the context in which they are used. Think of it like navigating with a GPS. You wouldn't blindly follow its directions if the road ahead looked impassable, or if your intuition screamed that the route was illogical. You'd learn to read the terrain, understand the prevailing traffic patterns, and question the suggested path when it felt intuitively wrong. This video has been your terrain map, helping you understand the landscape of financial modeling, its hidden pitfalls, and and its inherent assumptions. The mistake of the black box must be dispelled. Financial models, no matter how complex their equations, are built on a foundation of assumptions about the future. Understanding these underlying assumptions is not just important, it is more critical than grasping every intricate mathematical formula. It is the key to unlocking their true value and their potential dangers. So, how do we begin this critical engagement? Implement a personal model audit checklist for any financial projection or strategy you encounter. Start by asking, what are the core assumptions being made here? How realistic are they in the context of today's world? What are the unknown unknowns that this model likely ignores? Crucially, how does this model account for the unpredictable force of human behavior and emotion? The ultimate takeaway is this: true financial mastery lies not in finding the single perfect model, but in developing the wisdom to question, to test, and to constantly adapt all models to the messy, unpredictable reality of markets and human nature. We've journeyed through the intricate landscape of financial modeling, uncovering the silent architects that can lead us astray. We've unmasked three critical hidden assumptions: the illusion of predictable stability, which whispers that the future will echo the past; the rational actor fallacy, which presumes an emotional void where human psychology thrives; and the perfect information mirage, which pretends that all relevant data rests in plain sight. These are not isolated errors, but interconnected threads that, when left unexamined, weave a dangerous tapestry leading to costly mistakes. Warren Buffett, a man who embodies the wisdom of questioning, reminds us it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. This principle extends to our use of models themselves. It is far better to employ a model that you understand is flawed, yet approach it with critical awareness, than to blindly trust a seemingly perfect one whose hidden assumptions you haven't dared to question. The true value lies not in the model's complexity, but in our diligence. By understanding and actively auditing the assumptions that underpin any financial projection or strategy, you begin a profound transformation. You move from being a passive recipient of potentially flawed predictions to an active, discerning investor. This critical lens empowers you to navigate the inherent complexities of the market with greater confidence and a far greater likelihood of success. You are no longer merely following a map drawn by strangers. You are learning to read the terrain yourself. This is the essence of true financial mastery, not the elusive pursuit of a perfect, error-free model, but the development of the wisdom to question, to test, and to continuously adapt all models to the vibrant, often chaotic, reality of markets and the enduring force of human nature. We invite you to apply this critical lens to your own investment strategies. What assumptions have you encountered? What costly mistakes have you learned from? Share your insights and experiences in the comments below, and let us continue to build a community dedicated to informed, data-driven decision-making together.